Here then is a downtrend. It's the dollar yen, spot dollar yen, and it's a trend from 2007 to the present day, 2011, late 2011. It's a bear market characterized by lower highs, succession of lower highs, and a succession of lower lows. How does the technician define the trend? He draws a line between the highs, succession of higher highs, and while this line remains intact, he calls that the trend line resistance, the bear trend resistance. While it remains intact, the trend is intact. The more points that are touched by the highs, the more impressive and more well structured the bear trend is. Basically, this is defined at 4 points. That's very powerful. What may at first seem to be a very well described trend may not be perfect. Trends rarely are, patterns rarely are, technicals are rarely perfectly realized. And that difference between reality and the perfect or archetypal representation of what the perfect trend should be, how the perfect trend should be described, is where technicians work that gap. Because they have to make judgment calls as to when the perfect is slightly less than perfectly realized in the real life. And that's where judgment comes in and experience as to whether it remains a trend even though it's not perfectly realized or not. What number of points is the minimum to define a trend line? Obviously 2, since 2 points are required to define a line. 3 makes it more powerful because it's a testing of the line established by 2 points. And of course 4 makes it more powerful still. The trader obviously has to consider, looking at this chart today, a well-established trend. Is it likely to continue? Or is it on the point of breaking? He doesn't have to answer that question. He may simply decide, this is a powerful trend, well established at 4 points, I'm a seller here, and my stop is above that diagonal, so that if it were to close above the diagonal, I'll chop out. That would be a perfectly rational decision.